Chart patterns are the secret language of the markets, revealing potential trading opportunities and guiding your decisions towards success. Understanding these patterns can be the difference between a winning trade and a missed opportunity. Welcome and thank you for joining us today. Get ready to unlock the power of chart patterns and transform your trading strategy. We're diving into the fascinating world of chart patterns, uncovering essential patterns and exploring their significance in trading. Why are chart patterns so crucial for traders? They provide insights into market behavior, helping you predict potential price movements and make informed decisions. Understanding these patterns can give you a significant edge, turning the complexities of the market into a clear roadmap for success. Stay tuned as we break down these patterns and show you how to use them to your advantage. Chart patterns are a fundamental aspect of technical analysis, providing visual cues about market sentiment and potential future movements. Today, we'll introduce you to some basic chart patterns that every trader should know. These patterns, such as head and shoulders, double tops and bottoms, and triangles, serve as powerful tools to predict price action. By recognizing these formations, you can gain insights into market trends and make more informed trading decisions. Understanding these basic patterns is the first step toward mastering the art of trading. Stay with us as we delve deeper into each pattern, revealing their unique characteristics and how to leverage them for successful trading. The head and shoulders pattern is one of the most reliable indicators of a potential trend reversal in trading. This pattern consists of three peaks, a higher peak in the middle, known as the head, flanked by two lower peaks, called the shoulders. To spot a head and shoulders pattern on a chart, look for a strong upward trend followed by the formation of the left shoulder, the head, and then the right shoulder. The pattern is complete when a neckline, which connects the lows between the shoulders and the head, is drawn. The key moment for traders is when the price breaks below this neckline, which often signals a bearish reversal, indicating that the upward trend is likely coming to an end. Identifying this pattern involves patience and attention to detail. The left shoulder forms after a significant price increase, followed by a peak and a slight decline. The head is created when the price rises again to a higher peak before declining again. Finally, the right shoulder forms when the price increases once more, but fails to reach the height of the head before falling again. For trading decisions, the head and shoulders pattern is a strong signal to consider selling or shorting an asset. This pattern suggests that the bullish trend is weakening and a downward trend may be imminent. Traders often wait for a break below the neckline to confirm the pattern before making their move. Let's consider a practical example. Imagine a stock has been on an upward trend, reaching a peak at $50, dipping slightly, then surging to $60, falling again, and finally rising to $55 before declining once more. Drawing a line across the lows between these peaks forms the neckline. When the stock price falls below this neckline, it confirms the head and shoulders pattern, signaling a potential sell opportunity. Up next, we'll dive into the double top and double bottom patterns, which are also crucial for identifying potential market reversals. Stay tuned to learn how to spot these patterns and use them to your advantage. The double top and double bottom patterns are powerful tools for predicting market reversals. The double top pattern is characterized by two peaks at roughly the same price level with a trough in between. It signals that an asset is struggling to break through a resistance level twice, indicating a potential bearish reversal. When the price falls below the support level formed at the trough, it confirms the double top pattern and suggests a sell-off may follow. On the flip side, the double bottom pattern features two troughs at a similar price level, separated by a peak. This pattern indicates that an asset is finding strong support at the same level twice, suggesting a bullish reversal. When the price rises above the resistance level formed at the peak, it confirms the double bottom pattern and signals a potential buying opportunity. Identifying these patterns involves looking for specific features. For a double top, spot two peaks that are nearly equal with a noticeable dip between them. For a double bottom, look for two low points that are about the same, with a noticeable rise in between. Consider this practical example. Imagine a stock hits a high of $80, drops to $70, then rises again to $80 before falling back. The resistance at $80 and the support at $70 form the double top pattern. If the price drops below $70, this confirms the pattern, indicating a potential downtrend. Conversely, if a stock drops to $30, rises to $40, then drops again to $30 before climbing, this forms a double bottom pattern. When the price rises above $40, it confirms the pattern, signaling a potential uptrend. Next, we'll explore triangle patterns, which are essential for understanding market consolidations and breakouts. Stay tuned to learn how to leverage these patterns in your trading strategy. Triangles are important chart patterns that can help predict market movements. There are three main types: ascending, descending, and symmetrical triangles. An ascending triangle forms when the price is rising to a consistent resistance level while the lows are getting progressively higher. This pattern suggests a bullish continuation, as buyers are pushing prices higher but meeting resistance at a specific level. When the price finally breaks through the resistance, it usually indicates a strong upward movement. A descending triangle, on the other hand, forms when the price is dropping to a consistent support level while the highs are getting progressively lower. This pattern suggests a bearish continuation, as sellers are pushing prices lower but meeting support at a specific level. A break below this support often signals a significant downward movement. Symmetrical triangles occur when both the highs and lows are converging towards each other, forming a triangle that points to the right. This pattern indicates a period of consolidation where neither buyers nor sellers are in control. The breakout direction, whether up or down, typically signals the direction of the next major move. To identify these patterns, look for the key characteristics. For ascending triangles, find a horizontal resistance line with higher lows. For descending triangles, find a horizontal support line with lower highs. And for symmetrical triangles, look for converging trend lines that connect the highs and lows. Here's a practical example. If a stock's price rises to $40 multiple times but can't break through, while the lows rise from $35 to $37 and then $39, this forms an ascending triangle. When the price breaks above $40, it usually signals a strong upward trend. For a descending triangle, imagine a stock falling to $20 multiple times, but bouncing back to progressively lower highs of $25, $23, and $21. When the price breaks below $20, it often signals a strong downward trend. With a symmetrical triangle, if a stock's price fluctuates between $30 and $40, but over time the highs and lows converge towards $35, a breakout in either direction could signal the next major price movement. Next, we'll explore flags and pennants, which are also crucial for identifying market trends and potential breakouts. Stay tuned to see how these patterns can further refine your trading strategy. Flags and pennants are key patterns that signal price continuation, providing traders with insights into potential future market movements. A flag pattern forms after a strong price movement, known as the flagpole, followed by a period of consolidation with parallel trend lines that slope against the prevailing trend. This pattern resembles a flag on a pole. It indicates that the market is taking a breather before continuing in the same direction. When the price breaks out from the flag formation, it typically continues in the direction of the initial move. Pennants are similar but slightly different. They also follow a strong price movement and consist of a small, symmetrical triangle that forms as the price converges. Pennants indicate a brief consolidation before the market resumes its previous direction. The breakout direction from the pennant generally follows the trend preceding its formation. To identify these patterns, look for the strong initial move that forms the flagpole. For flags, identify the parallel trend lines that form the consolidation phase. For pennants, spot the converging trend lines that create a small triangle. For example, imagine a stock surges from $10 to $20, then enters a brief consolidation phase where the price moves between $18 and $19 in a downward sloping channel. This is a flag pattern. When the price breaks above $19, it usually indicates a continuation of the uptrend. Similarly, if a stock jumps from $15 to $30 and then forms a small triangle between $28 and $29, this is a pennant. A breakout above $29 suggests the continuation of the upward trend. Next, we'll discuss practical tips to effectively use these patterns in your trading strategy, ensuring you make the most informed decisions. Stay tuned for actionable advice to enhance your trading approach. Now, let's talk about practical tips for using chart patterns to enhance your trading strategy. First, combine chart patterns with stop-loss orders. This helps you manage risk effectively. For instance, if you identify a head and shoulders pattern signaling a bearish reversal, place a stop-loss order just above the right shoulder. This way, if the pattern fails, your losses are minimized. Second, use market limit orders to optimize your entries and exits. When you spot a double bottom pattern indicating a bullish reversal, set a market limit order at the breakout point above the peak between the troughs. This ensures you enter the trade at the most opportune moment, maximizing potential gains. Third, integrate stop limit orders for better control. If you identify an ascending triangle and anticipate an upward breakout, set a stop limit order above the resistance level. This allows you to capitalize on the breakout while controlling the price at which your order is executed. Next, we'll discuss the tools and platforms that can help you implement these strategies effectively, making your trading process more efficient and precise. Stay tuned for insights into the best resources available to traders. Let's explore how you can use RTrader Pro to analyze chart patterns effectively. RTrader Pro is a powerful trading platform that offers a range of tools for technical analysis, making it easier to identify and act on key chart patterns. First, let's analyze the head and shoulders pattern in RTrader Pro. Start by selecting your asset and opening the chart. Use the drawing tools to mark the peaks and troughs. Identify the left shoulder, head, and right shoulder. Draw a neckline connecting the lows between the shoulders and the head. Monitor the price action closely and set alerts for when the price approaches the neckline. If the price breaks below the neckline, it confirms the pattern, signaling a potential bearish reversal. Next, identifying double tops and bottoms is straightforward with RTrader Pro. Open the chart for your chosen asset. Look for two distinct peaks for double tops or troughs for double bottoms at similar levels. Use the drawing tools to mark these points and the support or resistance level between them. Setting alerts at these levels can help you act quickly when the price confirms the pattern by breaking below the support or above the resistance. Spotting triangles in daytrader Pro involves a similar process. For ascending triangles, draw a horizontal line at the resistance level and a rising trend line connecting the higher lows. For descending triangles, draw a horizontal line at the support level and a descending trend line connecting the lower highs. For symmetrical triangles, draw two converging trend lines. Monitor for breakouts from these patterns to predict the next price movement. Recognizing flags and pennants in daytrader Pro requires identifying the flagpole first. Look for a strong price movement, then draw parallel trend lines for flags or converging trend lines for pennants during the consolidation phase. Setting alerts at the breakout points can help you take advantage of the continuation of the trend. In the next section, we'll share final tips and wrap up our discussion, providing you with actionable insights to enhance your trading strategy using these tools. Stay tuned for the concluding remarks. Let's wrap up by recapping the key points we've covered about chart patterns and their importance in trading. We discussed the head and shoulders pattern signaling potential trend reversals. We explored double tops and bottoms, indicating market turning points. We covered triangle patterns that show periods of consolidation and potential breakouts. Finally, we looked at flags and pennants, which are useful for identifying continuation patterns. When using these chart patterns, it's crucial to confirm patterns before acting, looking for key signals like breakouts or breakdowns to validate the pattern. Combining chart patterns with other technical indicators, such as moving averages or volume analysis, can increase the accuracy of your predictions. Using stop-loss orders helps manage risk and protect your capital. Setting them just beyond the pattern's key levels can avoid premature exits. Be patient and wait for clear patterns to form, as rushing into trades based on incomplete patterns can lead to losses. Applying these strategies can significantly enhance your trading effectiveness. Remember, the key to successful trading is continuous learning and disciplined execution. Stay committed to refining your skills and applying these patterns in your analysis. Your dedication will pay off in the long run. We'd love to hear from you. Share your experiences and questions about using chart patterns in your trading. Your insights and interactions help create a richer learning experience for everyone. Next time, we'll dive into advanced trading strategies, focusing on how to leverage indicators like Bollinger Bands and Fibonacci retracements. Stay tuned for more in-depth insights and practical tips that can elevate your trading game. Thank you for joining us today. Keep exploring, stay curious, and happy trading.